Let's take a look at how to trade ranges, how to trade small price action, and how to find better trades with a top-down approach. Hello, welcome back, and this is very common to see this behavior. You have tight, very nice and narrow ranges, but on the higher time frames, in this case this is the 4-hour time frame, such periods should not be traded because you will get whipped around. You will see that the moves are very small, very shallow, and the technical analysis, wave analysis, trend analysis is obviously not applicable here. You cannot and you should not trade a range that is so tiny and so narrow. But if we are able, or once we are able to define such a range by using horizontal support and resistance, and once you see that the market and the price action is really respecting those technical boundaries that well, and we want to make sure that we really capture the beginning and the highs of the range, we can use this information on the lower time frames to turn ranges into a trend following trading approach. So now we are on the 15-minute time frame. Before we were on the 4-hour, and this is the exact same range. You can see those are the resistance areas, those are the support areas. And once we have identified the ranges and the range boundaries, once we have identified the first swing point, we will be able to use this going forward. And what we want to look for especially are fake outs and price patterns. We want to see a fake out above the highs, and we want to see a pattern that is helping us to trade a reversal back into the range, such as in this case, this is the first time the market moved outside of the range and it immediately falls back into the range. And we can apply a horizontal level of support and resistance to this. So here you can see we can very nicely define this pattern. We have a resistance level that turns into support, and then on the pullback it turns into resistance again. So there are multiple ways how you can approach this. You can even use, if you don't see the first level, you may use even the lower one, where you now are able to see a really well-defined head and shoulders pattern. So now here, this is how the head and shoulders looks like. A very tiny right shoulder, which is what I call the breakout buildup. So before or after the market moved into the level, the price is not able to pull away from the level. By this, we already know that we have a fake out because the market is pulling back into the range. So we're looking for trade continuations into the downside. And once this is broken, you may use this as your entry trigger on the successful breakout. Then you look for continuations to the downside. And you may target the previous lows. You may use a fixed reward to risk ratio. But you can see those narrow ranges on the higher time frame. They are now looking like very well-defined trends on the lower time frames. And here we can use principles such as pattern, we can use principles such as support and resistance, of trend analysis, of wave analysis, whereas on the higher time frame all you have is an up and down without any way how to apply price action and candles and fake out information. But on the lower time frame, not always will you be able to apply it. Sometimes we have the fake out here above the first high. And then you may have to wait again. If we draw it like this, you may have a very dirty head and shoulder, but not always will this work out. You really want to see that the market is breaking above the previous high point. This is the first and initial swing high of the pattern. Some traders may even want to draw it a little bit deeper just to get the most confluence. So you have the most confluence here on the lower side where you have all the closes. And then you can see even here the first move, we didn't have a fake out, but you can clearly see how the market finds resistance here, how it shows this rolling over pattern. Here you have the real fake out above the complete highs. Here you have a fake out. You can see the market moves back into the support level that we identified here. And you can see we have another very tiny head and shoulders, but regardless, we have an inverted head and shoulders. Left shoulder had the right shoulder. And there are many ways how you can approach this trading approach. You just then wait again. You don't get engaged when the market is in the middle of the range. you really want to make sure that you wait for the market to get into the outer parameter. Like in this case, we have a very, very well-defined fake out and this huge move in one candle back into the previous highs. Then on the previous highs, you can see we hit the resistance once again. We can either draw our level like here, or we have another level in here. Multiple ways how you can approach this, the breakout and the pullback. You have another inverted head and shoulder at the fake out level here, left shoulder that had the right shoulder, a breakout, and then a trend continuation back into the highs once again. So many ways how you can approach the boundaries. You can see multiple fake outs. This is a spring pattern or multiple spring patterns with a tweezer, a candlestick formation. A tweezer is 2 or more candlestick wicks pointing into the same direction, faking out the highs. You can see we have another very well-defined area in here with multiple swings and fake outs. Then a nicely low here. After the breakout, the market collapses, moves back into the previous supply area in here. And this is a pattern that is, you can trade this 7, 8, 9 times just within this same range. We don't even have to adjust our levels. We keep the levels constant at the level of the first high and the first low. And then we just wait for the market to get back into the highs and into the lows. And you can see here we have our last, seemingly the last fake out, where the market has a small sell-off back into the previous support and resistance areas. And then here, the market has here its low point, and then afterwards, the market breaks above the highs, exits the range, and then never looks back. And this is then obviously when you can eliminate the range from your charts, and you can wait for the next range to build on the higher time frames and go down to a lower time frame. So this is a very, very simple trading approach, a very effective one, and especially in times when the momentum is not that high, when you see that the market is stuck in ranges, find those ranges on the higher time frames and trade them on the lower time frames accordingly. You can see that here's the first high, here's the first low, and then you have 1, 2, 3, 4, 5, 6, 7 multiples here, 9, 10, the last one 11 times how you could have traded after you've identified the first swing high and low. So it's really, really recommended, and I said it in so many previous videos. Look at previous highs and lows, identify important swing highs and low points, and then wait for fake outs around those. Go to my channel and search for fake out trading or fake out strategies. You will find previous videos where I explain a very similar fake out strategy and how to approach it in your trading. It's very straightforward. You don't need to be a rocket scientist to trade this, but it's very important that once you see that the market is not giving you a lot of movement anymore, not a lot of room, then you switch to a lower time frame where even small moves may look like big trends on the lower time frames. And then you apply chart analysis, pattern analysis, breakouts, and all of those things to your charts. I hope this helps. I hope you find this interesting. If you did, leave a comment below. I look forward to hearing you in one of the next videos.